Hi friends, good morning and welcome once again. So today we are going to have a detailed discussion on income under the head salary. So this is in continuation with what we have seen so far under the understanding income tax, where the agenda is to go through the entire income tax act systematically over a period of time. We've seen the basics, we've seen scope of total income and residential status. So today the focus is going to be on chargeability of income under the head salaries. Moving on, I would like to thank Bharti and Jugal for their sincere contribution in getting this in place, the presentation done for us. So these are some of the definitions. Recognized Provident Fund, HRA, and CIT, of course, stands for Commission of Income Tax. I guess most of the others are anything which we have seen otherwise in our earlier presentations. Yes. So this is what we intend to see, friends. First is about basis of charge, what are the deductions, exemptions, and salaries we have, how perquisites are taxed, how allowances are taxed, how profits in lieu of salary are taxed, and what are the reliefs available under retirement benefits and for various categories of benefits which an employee gets from his employer. And of course, we shall also be looking at a few relevant judicial precedents in this regard. So fundamentally, when we look at the act per se, so salaries, unlike your other heads of income, focuses a lot of its emphasis on the rules and notifications vis-a-vis the section, because section only gives you the macro level guidance. Section 15 is the charging section. Section 16 talks about deductions, and 17 talks about perquisites and profits in lieu of salary. Very, very simple three sections. But the chapter, as I said, fundamentally revolves around rules and notifications in this space. So let's get into the charging section. So as we've seen, section 4 is the charging section for the Income Tax Act. Likewise, every head of income has its own independent charging section. So section 15 is a charging section for salaries, which focuses on the basis of charge. Unlike if you look at the case of business income or income from other sources, section 145 gives the assessee an option to choose between cash system or mercantile system of accounting. If you look at capital gains, the section itself categorically talks about what is the method of accounting to be adopted under various circumstances. Basically, it is on transfer, but there are certain specific sections like 45(1)(a), 45(5) compulsory acquisition, where the 45(2) conversion. So where the actual chargeability is deferred to the date of receipt of consideration. So there are specific situations in which incomes gets taxed as under accrual basis and certain circumstances on the basis of cash basis. But as far as salary income is concerned, if you look at the language, it says any salary due from an employer is taxable, whether paid or not. Any salary received, even if it is received from an employer, is taxable. Advance salary is not taxed because it is deemed as a uh, loan. Arrears of salary is taxed on receipt if it was not taxed on an earlier basis. So technically, when we look at it, salary is taxed on the basis of either receipt or due, whichever is earlier. So let's say for the month of March, your salary is due by 31st of March and it is paid on first week of April. You will still have to pay tax on first week for March salary in the earlier financial year on due basis. So we go by receipt or cash or accrual, whichever is earlier. Now, in the case of partner's remuneration, such income shall not be subject to tax under the head income from salaries because there is no employer employee relationship. The relationship between a partner and his firm is not regarded as an employer employee relationship, it is more an owner relationship, which is why partner's remuneration comes under the ambit of section 28 and gets taxed as business income. Deductions. So, standard deduction has been reintroduced, and the current standard deduction for salaried category is 50,000 or the amount of salary, whichever is less. So, if you look at it, friends, currently we have three deductions under salaries. One is standard deduction, entertainment allowance, and professional tax. Entertainment allowance is available only for government employees, whereas professional tax and standard deduction are available for all employees. So standard deduction limit is 50,000 or salary, whichever is less. Entertainment allowance fairly straightforward. It's a least of the three. Actual amount 5,000 or one fifth of basic salary. Again, whichever is less. Professional tax actual amount paid by the employer or employee will be allowed as a deduction. If it is paid by the employer, it will be added to income as obligation of an employee made by the employer and then allowed as a deduction. That's where it stands. If it is paid by the employee, then it will get straight deducted as a professional tax deduction. So fairly straightforward, nothing much as far as deductions are concerned. Now let's focus on the definition of the term salary. So we've seen section 15, 16. Now we are moving on to 17. So salary includes, so it's an inclusive definition, not an exhaustive definition. Includes wages, annuity or pension, gratuity, fees, commission, perquisites, advance salary. It is not advance against salary. There's a difference between the two. So if it's pure advance salary, it's taxable on receipt basis. Leave encashment is taxable. Annual accretion uh, to the credit of an employee in a recognized provident fund, again to the extent it is taxable, we shall see in some time from now. Any funds transferred from a recognized provident fund to the extent it is taxable. Then contribution unto a pension scheme. So these are the various forms. So possibly whatever benefit the employer can offer an employee will be subject to tax. And also all perquisites and allowances are also subject to tax. Now let's look at the case for allowances. Now before I get into allowances, let's have a conceptual understanding. Salary includes whatever is a cash emolument which someone receives, which is typically as basic as DA and all those things. Then allowances could be for monetary payments for very specific expenses. It could be travel, it could be research, it could be for lunch, whatever you call it. Some of them are exempt, some of them are partially exempt, some of them are fully exempt. Then we look at the case for perquisites, which are benefits which are being offered to an employee. Invariably, these are in kind, where the employer is going to give you a car. That's a classic case of a perquisite. Now, after this, we have retirement benefits, which is typically your provident fund, pension, and all those contributions. Then we also have something called as profits in lieu of salary. Each of these have its own set of variations and how they are categorized in terms of exemptions. Let's now look at each of these. When we look at allowances, allowances can be broadly categorized as fully taxable allowances, partially taxable allowances, and fully exempt allowance. So for us, the first and the last are fairly straightforward. Anything which comes under fully taxable, there is no need to worry. It's fully taxed. Just goes straight to your computation of income under the head salaries. So what are those? DA, overtime allowance, fixed medical allowance, city compensatory allowance, interim allowance, servant allowance, project allowance, lunch or tiffin or dinner allowance, not lunch, tiffin or dinner given inside the premises. Any other cash allowance, warden allowance, non-participating allowance, transport allowance. This is interesting, friends, because earlier transport allowance was eligible for exemption up to 800 or 1600, but now that relief is removed and standard deduction has been introduced. So all these are fully taxable. Similarly, let's look at fully exempt allowance. There's no rocket science. Allowances to high court judges, allowances paid by UNO, compensatory allowance received by a judge, sumptuary allowance granted to High Court and Supreme Court judges, allowances granted by government to citizen of India for rendering services outside India. Then we look at what are the partly taxable allowances. So now this is where we need to use some levels of application. House rent allowance is partially taxable 1013A. Entertainment allowance is partially taxable. We had those three classes. Special allowance under section 1014, that in turn has a list of allowances. Some of them are exempt to some certain limit and they are taxable beyond that particular limit. Let's now focus our attention on partially taxable allowances. First one, house rent allowance. So this is an allowance. Let's say an employee is working in Chennai and he moves from Chennai to Bangalore. So basically the house rent allowance is given to someone for who ideally he is not living in his place of residence or he does not have a own house in his place of residence. Then in such circumstances, an exemption for HRA is possible. Now, HRA exemption is categorized based on place of residence. So you have metro cities based on an erstwhile definition of the term metro, which is why you have only those four metros: Mumbai, Kolkata, Delhi, and Madras or Chennai. But your places like Hyderabad or Bangalore or Gurgaon, all these are as expensive or if not more than metros, but any which ways. And a non-metro other than metro. What are the slabs? Rent, actual HRA received, rent paid minus 10%. These are standard for both, minus 10% of salary, and 50% of salary for metro and 40% of salary for non-metro. Now, again, when we look at it, friends, HRA exemption is not available to someone who lives in his own house or in a house for which he is not paying rent, because rent paid will be zero, in which case the least of the three, so automatically the slab becomes zero. And definition of the term salary here, salary effectively means basic plus DA forming part of salary for retirement benefit plus commission if any payable to an employee on the basis of percentage of turnover achieved by him, which is sales commission or whatever you call it. Then we've already seen entertainment allowance, so let's move on to special allowances. So allowances granted to meet specific expenses which are effectively incurred for the purpose of employment, and allowances which are granted to meet his personal expenses for the purpose of his place of being, the place of his employment being in such kind of a location. For example, hilly area 11, someone, let's say the army employees, they will have to, the Jawans have to work in tribal areas, hilly areas, Siachen Glacier. Automatically, their requirements are high. It's very demanding. Such cases, obviously, they will end up spending slightly more, or compensation will be high to ensure that they don't get taxed for their excessive efforts which are being put in. Automatically, certain reliefs are being provided. Let's look at each of these. Now, allowances prescribed for the purpose of 1014.1, the places where your work for the purpose of your employment, you are expected to spend certain amounts for some specific expenses. So, which is your traveling allowance, which is your tour expenses, where you travel on behalf of your employer. Daily allowance when you're on tour for your food and accommodation, your employer pays some helper allowance. Let's say you're a professor and you're allowed a helper. Uniform allowance, most of the factories have this. Research allowance, where again you're a researcher and you're given a junior for your research activities. Conveyance allowance, which is there for the purpose of your traveling, for the purpose of office, not between residence and office, travel for the purpose of office. So all these allowances, if they are entirely for official purposes, they are fully exempt. There's no limit, they are fully exempt. But these are, if they are used for personal purposes, automatically they become taxable. Next, special allowances, where these are exempt to the extent specified. So hilly area allowance in specified locations, it's 800 or 300 a month or 7,000 per month if it's Siachen Glacier. Border area, remote locality allowance, the exemptions vary from 1,300 to 200 per month. Tribal areas, scheduled areas which have been notified. If the assessee lives but also owns a house, good question, Sundar. Yes, HRA exemption is available. As long as you are able to prove that you are paying rent actually, automatically HRA exemption is available. So, any allowance granted to an employee working in any transport system, in such cases, 70% of such allowance up to a maximum of 10,000 a month. Children's education allowance, it is 100 per month per child, up to a maximum of two children. I don't know where these are anyway in sync with inflation or reality. Hostel expenses is 300 per month per child, again subject to a maximum of two children. Compensatory field area allowance 2,600. Modified area only in specified 1,000 per month. Counter insurgency 3,900. Transport allowance, this is the only transport allowance which are available, which is available for exemption, because every other transport allowance is fully taxable. For an employee who is blind or deaf and dumb or orthopedically handicapped, 3,200 per month. Underground allowance for those who are working in coal mines or underground mines, it's 800 per month. High altitude allowance, it's 1060 or 1600 based on the altitude of the place. So these are fairly clear and straightforward allowances. Couple more highly active field area allowance, it's 4,200 for members of armed forces. Island duty, especially for those who are in Andaman and Lakshadweep, 3,250 per month. These allowances are exempt to the extent specified. Anything beyond this they are taxable on such excessive amounts. Moving on, meaning of the term perquisite. Perquisite, as we saw, it's an extra benefit which is available, ideally in kind. In certain cases, it is in cash as well. Again, you need to have the employer-employee relationship for the purpose of having a perquisite. What are the types of perquisites? They're taxable for all, taxable only, exempt for all employees, and taxable only for specified employees. So again, when we categorize perquisite, we can do it across three specific categories: fully taxable, fully exempt, and taxable only for specified employees. Fairly straightforward. Moving on, taxable for all: rent-free accommodation, whether it is furnished or unfurnished; concessional rent; payment by employer in respect of an obligation of an employee. So, which is an obligation of an employee met by the employer. We saw even professional tax will come under this ambit. Amount paid by an employer directly or indirectly to effect an assurance on the life of the assessee, or to effect a contract for annuity. Specified or sweat equity ESOPs, amount of contribution to an approved superannuation fund, and any other fringe benefit or amenity as may be provided. So let's now look at each of these in terms of how they are actually taxable. Rent-free accommodation for furnished. So there is a, for a government employee, it's fairly straightforward. Whatever is a license fee specified by the government for that particular accommodation minus the rent actually paid. Next, accommodation provided by any other employer. Accommodation is owned by the employer, in which case you have to look at where the, what is the population of the city. It is 15% of the salary if the population exceeds 25 lakhs. 10% of the population is between 10 and 25 lakhs. 7.5% in other areas for the period for which the accommodation has been provided. We'll come to it as to what is the definition of the term salary. And for all these numbers, you will reduce the actual rent recovered from the employee. Accommodation is taken on lease or rent by the employer. Actual amount of lease rent paid or payable by the employer, or 15% of salary, whichever is lower, will be the value of perquisite. You will reduce the rent, if any, paid by the employee. Now, look at it, friends. For an unfurnished accommodation, if it's a government employee, license fee. If it is a non-government employee, based on the population of the city where the accommodation is provided, it is 15, 10, or 7.5%. If the employer has taken the accommodation on lease, because in the earlier cases it is assumed that the employer owns the accommodation. If the employer has taken a flat on rent and given to his employee, then it is the actual rent or 15% of salary, whichever is lower. This will be deemed as value of taxable perquisite in the case of rent-free unfurnished accommodation. To this, you will reduce across all circumstances whatever is the rent recovered from the employee, and that will be the value of taxable perquisite. Now, what happens if it gets furnished? So, if the furniture is owned by the employer, then add 10% of the furniture cost for as annual rent, where it is actually hired from a vendor, in which case you will add the actual hire charges for furniture. And what happens if the employer has taken the accommodation from a hotel? So, in which case, there's no question of furnished or unfurnished. 24% of the salary paid or payable, of the cost, 24% of the salary paid or payable, or the actual hotel cost, whichever is lower, shall be deemed as value of taxable perquisite. So, if, however, when you look at it, when invariably what happens when someone travels from one location to another, for a period of 15 days, if accommodation is provided in a hotel, it is not taxable. Up to 15 days, it is not taxable where someone is transferred. But beyond 15 days, obviously, it gets taxable. But this will not apply where someone travels from one place to another for a business purpose. This will apply only where accommodation is given as a residence. Someone is posted from India, you go to, from Chennai, you go to Bangalore for a small assignment for say 1 month or 1.5 months, and your employer is going to give you a hotel accommodation. That will not come under this. But you're shifting from Chennai to Bangalore. Your place of posting now becomes Bangalore, and there you stay in a hotel for 2 months. Automatically, beyond 15 days, this will get subject to tax. Hope it's clear. So, how does the computation of salary for the purpose of rent-free account? Because we saw 15, 10, or 7.5%. It is basic DA forming part of salary plus commission if any as a percentage of sales, bonus, fees, or any other taxable allowance to the extent it is taxable, not to the extent exempt, it is not the gross value. Okay. Accommodation provided in a remote or an offshore location, installation shall be exempt. So if someone's working in a oil rig or oil drill in the high seas, it's an offshore location, automatically accommodation provided will not be taxed. Next, obligation of an employee met by the employer is a fully taxable perquisite. Classic example, any reimbursement of any personal expenses, kids' education, payment of taxes, car is owned by the employee and insurance, maintenance, and all paid by the employer, servant costs paid by the employer. Automatically, any reimbursements will be fully eligible for taxation. Next, ESOPs. Now, um, when we get into capital gains, we'll understand ESOP technically has three events: vesting, the vesting date, the excise date, and the sale date. So the sale is relevant only for capital gain, so we're not going to spend time on that. So vesting date. So what is vesting? Let's say someone works for a period of 5 years in a company, and as per the company's rule, if you cross 5 years, you will be eligible for ESOPs. Now, when you are eligible for ESOPs, what happens? Automatically, you will be eligible for um buying the shares of the company at a concessional rate. Let's take the case of Infosys, a company which is very popular for its lavish ESOP scheme. So Infosys now works as a listed company, and an employee after 5 years is eligible to buy 1,000 shares of Infosys at say 100 rupees a share, whereas the market rate is 1,000 rupees. Now, the date on which he becomes eligible to buy these shares is what we call as a vesting date. So vesting date, he only gets a right, but he does not exercise it. What is relevant as far as income tax is concerned? The date on which he actually exercises this right, that's when this income gets subject to tax. Because that's when the option is exercised and the assessee is expected to pay tax on that money. Now, what is the amount? Let us say on the date of excise, the market value of the share is 1,200 and he gets to buy the share at 100 rupees. The difference between these two will now be subject to tax. So, this 1,100 will be subject to tax. So, what are the circumstances? The challenge when it comes to valuation of perquisite here is, how do I value the fair market value of shares? If the shares are listed, it is fairly straightforward. It is the average of opening and closing price on that date in the exchange. If it's listed on more than one, you take the exchange in which the volumes are high. If there is no trading on the share on the recognized stock exchange, then take the date closest to the date of exercise, preceding the date of exercise. And if the shares are not listed, then you go through a merchant banker valuation. So that becomes a fair market value of the share. You reduce whatever is the amount received from the employee, that becomes the value of taxable perquisite. Now, what happens if you are given shares other than equity shares? In which case, so now we have this concept of phantom shares, we can have preference shares, multiple instruments are possible. So, or any security, convertible debenture, anything can be given. Such case, you go through the fair market value by a merchant banker, reduce the value of amount recovered from the employee, that becomes a value of taxable perquisite. Next, we also saw when we saw the case for perquisite, certain fringe benefits also gets taxed. Now, what are the fringe benefits? Interest-free loans, use of movable assets, gifts, credit card, transfer of movable assets, traveling, tour, accommodation facility, etc., provided by the employer. Now, interest-free loans or loans at a concessional rate of interest. So, if the loan is given to an employee or any member of his household, if the lending rate, so invariably, let us say, and in many cases, employers have this case. If an employee is earning, say, 1 lakh, he'll be eligible to take a housing loan for 20 lakhs at 2% rate of interest, whereas a market rate would be 8%. So the difference between this 2 and 8%, that 6% will be subject to tax as value of taxable perquisite. Now, for this, you will take the SBI's benchmark rate for a similar product at the beginning of the previous year. Exceptions being if the loan is taken for a medical emergency or if the loan amount does not exceed 20,000 in aggregate, then in both these circumstances, automatically you will not be required to uh, determine value of taxable purpose. Use of movable assets, if it's laptops or computers, that is exempt. Other movable assets similar to rent-free unfurnished accommodation. For furnishings, we saw 10% of actual cost. Similar will be the case. Or if it is taken on rent, the rent as the case may be. Reduce any amount recovered from the employee for the purpose. Transfer of movable assets. This is something which happens. So employees will effectively have what to say companies will cars especially, let's say an employee gets a car from the company and the car is being used by the company for 4 years in the name by the same employee, and after 4 years the employee is given an option to buy the car. Let's say it's a Honda City worth 10 lakhs. After 5 years the employee is given an option to buy the car for 4 lakhs. The employee can either take it or not take it. That's his choice. Now, when this happens, what happens? The car worth 10 lakhs, maybe in its books of accounts, it could be worth say 6.5 lakhs or 5 lakhs, whatever. And it's 6 lakhs. Given to an employee at 5 lakhs, there will be a loss of 1 lakh. Forget the block concept at this point in time. So, but from an employee standpoint, he would still think that the car is worth much more because he's been using the car and he's getting a 10 lakh car for 5 lakhs. To determine what is the value of that car, the income tax department has given a mechanism for this. They say 20% of WDV for each completed year of usage, but the depreciation for regular tax purposes is 15%. You ignore whatever is the rate of depreciation. You go by what they have provided here. So, which is why for computers and electronic item it is 50%. For cars it is 20%. Any other asset it is 10%. But for any other asset it is straight line. But for the other two, cars and motor vehicles, it is for cars and electronics it is on WDV basis. But the challenge here is depreciation is computed on a completed year basis. So if the car is held for 4 years and 10 months, you will still go with 4 years. Next, any other perquisite. So if it's a traveling facility for official, fully exempt, personal, fully travel, and where you go on an official tour and extend it for a personal purpose, then to the extent of that extended stay will be taxed. Similarly, gifts up to 5,000 not taxable, beyond 5,000 fully taxed. Credit card for official, fully exempt, personal it is fully taxable. Club facility, fully taxable excluding sports or health club. Official use it is eligible for exemption. Next, what are the perquisites which are exempt from tax in all cases? Now, telephone is a facility, transport facility. So the employer has a bus and that takes employees and drops them. Privilege passes or privilege tickets. Perquisites allowed outside India by the government. Employer's contribution to group insurance. Annual premium paid by employer on personal accident. Refreshments. Subsidized lunch. Recreational facilities. Amount spent on training of employees. Some payable by employer to a recognized Provident Fund or an approved superannuation fund. Leave travel concession subject to limits. Medical facilities subject to limits. Rent-free official accommodation. Rent-free furnished residence. All these cases, they are exempt from tax. But when we say rent-free official and rent-free furnished residence, this is all during your travel and official travel and not personally for through permanently during the period of employment. Leave travel concession. Interesting calculation. LTC is eligible for exemption under 10 subsection 5 twice in a block of 4 calendar years. So the journey performed here, if it is, see, this is where some of the unique natures of income tax are introduced. If the journey is performed by air, where it's a flight journey, amount not exceeding air economy fare by the shortest possible route. Any other mode where rail service is available, first class AC is available again by the shortest possible route. So if you're traveling from Chennai to Goa and then to Bombay, so your final destination is Bombay. So we will take Chennai to Bombay, whatever is the airfare, that will be eligible for exemption. And where rail service is not available, public transport does not, you will go, but public transport is there. Whatever is a first class or deluxe class fare by bus, public transport is the only other option. Where that is also not there, Amount not exceeding first class airfare by the shortest route, as if the journey has been performed by rail. So you take the number of kilometers and then see if that distance, what is the general first class fare, AC, that's what you will take. So multi-destination allowance is exempt from the place of origin to the farthest point reached by shortest route. That's why. So Chennai, Bombay, and Delhi, you will only look at Chennai and Delhi. You will ignore the Mumbai piece. It's complicated, but it is still fine. Works. People still make use of this particular provision. Medical facilities. The following are exempt. Medical allowance, friends, is fully taxable. Any medical facility provided in a hospital maintained by the employer, reimbursement of expenditure actually incurred for medical treatment, premium paid to effect an insurance on the health of the employee, reimbursement of premium paid to effect an health insurance on the employee or his family, amount paid towards expenditure incurred outside India on medical treatment, including one attendant, if the gross total income of the employee is less than 2 lakhs. So, very rare people use this, but any which ways. So, value of medical treatment in any hospital maintained by the employer, reimbursement of expenditure actually incurred on medical treatment, premium paid to effect an insurance. So, medical allowance is taxable, medical facility is not taxed, medical reimbursement is not taxed, reimbursement of health insurance is not taxed, medical treatment outside India, as long as the gross total income of the employee does not exceed 2 lakhs per annum. Very rare, but still, it is also not taxed. Perquisites which are taxable only in the hands of specified employees. So, who is a specified employee? So, here we are talking about a category of employees who otherwise are well off or well settled. Director employee, director of a company, a shareholder employee, someone who owns 20% shares in the company, and the employee who draws in excess of 50,000. Please understand this is annual salary after deduction under section 16. 16 only three deductions: standard deduction, entertainment allowance, and professional tax. So, literally, everyone will be a specified employee. What are the perks which are taxable only for specified employee? Servants given by the employer, gas, electricity, or water, use of motor car, free or concessional educational facility. All these four are taxable only for specified. I don't think for an employee whose income, let's say, full standard deduction is there, is less than 90,000 or 1 lakh, this benefit will be given, but still, that's how the regulations are. These are very dated provisions. Car, if it is owned by the employer or hired by the employer, expense is met by the employer, and it is entirely for official use, not a perquisite. The challenge comes if it is partly for official use. If it is used partly personal and partly official. In such cases, up to 1600 cc, it's 1800 per month, and above 1600 cc, it is 2400 per month. If a driver is provided, another 900 rupees. Similarly, car is owned by the employer, expense is met by the employee. Up to 1600, it is 600 per month. Above 1600, it is 900 per month. If the chauffeur is provided, another 900 has to be added. So, detailed records are required to be maintained where it is entirely official to prove that the car is actually used only for official purposes. So, this is a fairly tricky case, which is why invariably people avoid saying it is fully official if the car is given to an employee. Servant is provided. Okay, so in which case, what can happen? Servants are engaged by the employer and it is reimbursed, then the entire value of the reimbursement will be taxed. Domestic servants are engaged by the employer and the facility it is provided to the employee, then the value of the salary paid. Whatever is the cost minus whatever gets recovered will be eligible for exemption. Gas, electricity, water supply, very simple. If it is paid by the employer for specified employee, actual expenditure will be exempt, will be taxable. If the employer owns these facilities and is extending it to the employee, then whatever is the manufacturing cost per unit will be eligible. This cost of providing the facility will be taxed. Free or concessional education. Educational facility is provided in the school maintained by the employer or a school which the employer has an affiliation. In such case, the value of the benefit, if it does not exceed 1000 per month, it is not taxed. Please understand. If it does not exceed 1,000, it will not be taxed. If it exceeds 1,000, the entire amount will be taxed. And any other case where, let's say, the facility is not owned or affiliated to the employer, but the employee spends for this expenditure for the kids education in some school and gets it reimbursed, such cases the amount of expenditure incurred by the employer in this behalf shall be fully deemed as a value of taxable purpose. Invariably these things happen for expat salaries. So a foreigner would say, I want my kids to study in American international school. It will be 20 lakhs per child. That expenditure will be fully eligible for exemption. Next, meaning of profits in lieu of salary. This is the last one. Profits in lieu of salary, effective, which it also talks about retirement benefits. In lieu of means instead of salaries. So what does it entail? Compensation on termination of employment, which is termination compensation. Compensation on account of modification of the terms of employment, and payment from Provident Fund or a fund other than gratuity, pension, public Provident Fund, or recognized Provident Fund, Workmen's Compensation Act, Superannuation Act. Now, keyman insurance, because keyman insurance effect is an insurance taken by the employer on behalf of the employee for his relevance to the institution. Lump sum payment either before, which is called as before joining the employment, which is what we call as joining bonus, or after the cessation of his employment, which is, we can say, a golden handshake. Looking at it, pension. Let's look at each of these components in some detail. Pension can be two types, commuted and uncommuted. So commuted pension, let's say someone's worked for 25 years and at the time of retirement, let's say his corpus is 30 lakhs. He has an option either to take the entire 30 lakhs or take keep the amount with the employer and take 40,000 a month, or he can take 15 lakhs and take 20,000 a month. All these are possible. So whatever he gets as lump sum is what we call as commuted pension. Whatever he gets it on a monthly installment basis is what we call as uncommuted pension. For commuted pension for a government employee is fully exempt. For other employees, there's a situation. If he receives gratuity, then one third of the full value of commuted pension, let us assume in our example, the total value of commuted pension is 30 lakhs and he gets 15 lakhs, which is half. And assuming he also gets gratuity. In such cases, one third of full value of commuted pension, so one third of 30 lakhs, which is 10 lakhs, will be exempt. So out of the 15 lakhs he receives, 10 lakhs will be exempt, and the balance 5 lakhs he has to pay tax. However, if this employee does not receive any gratuity, then half of full value of commuted pension, this is half of 30 lakhs, shall be eligible for exemption. So 15 lakhs will be exempt. 15 lakhs is what he received. So the entire commuted pension will be exempt. Uncommuted pension, straightforward, whether it is government or non-government, will be fully taxable. Similarly, gratuity. Gratuity at the time of death for a government employee is fully exempt. For other than government employee, if he is covered by payment of gratuity act, in such cases there is a slab. 20 lakhs actual gratuity received, or 15 days salary. When we say 15 days salary, it is 15 by 26. And salary here is your last drawn salary, and definition is basic plus DA. So 15 days salary for every completed year of service. So you will round it off. So it is 16 years and 8 months. So you will make it as 17 years. Whereas if the employee is not covered under Payment of Gratuity Act, becomes 10 lakhs is the maximum exemption limit. Actual gratuity received, or half a month's salary, which is whatever is the salary by 2. So this will be lower than 15 days salary. And when we say salary, it is not the last drawn salary, it is the average of the last 10 months salary. For each completed year, you will ignore the fraction. So if it is 16 years and 8 months, you will still take it as 16 and not 17. Definition is basic plus DA or commission, and salary is whichever is the least of the three will be eligible for exemption in both these cases. And when it comes to gratuity received during service, it is fully taxable. So all the exemption criterion will apply only when it is received at the time of death or retirement. Even for government employees, gratuity during service will be fully taxable. Next, leave salary or leave encashment. So when you talk about leave salary, If it is received on retirement or superannuation, the government employee fully exempt. Other employees, then you have this 1010A, 3 lakhs actual leave salary, 10 months average salary, cash equivalent to unavailed leave, subject to a maximum of 30 days for every completed year of service. So, how does it work? So, let's assume someone's worked for 20 years and he has received 5 lakhs as leave salary, in which case 3 lakhs is one amount, leave salary actual received is 5 lakhs. Let's say his last drawn salary is 40,000, last 10 months salary is 4 lakhs. Cash equivalent to unavailed leave. So whatever is the total leave he has taken will be parked. Let's say over the last 30 years, he has worked, he has taken a leave of 300 days. And the earned leave entitlement cannot exceed 30 days. So let's assume for 30 days, the employer says annually he can take 35 days leave, but we will ignore the 35 and take only 30 because that earned leave entitlement cannot exceed 30. So 30 into 30, which is 30 days per year for 30 years, which will make it 900 minus 300 days of availed leave. So his unavailed leave is now 600 days. 600 divided by 30 will give you 20 months. And his last drawn salary is 40,000. So 20 months into 40,000 will make it 8 lakhs. So that's how you get to the last number. Whichever is less, so will be eligible for exemption. So in our example, it is 3 lakhs, 5 lakhs, 4 lakhs, or 8 lakhs. So you will obviously take 3 lakhs. Salary definition is basic plus DA or commission. Then, if it is received during the service, it is fully taxable. However, he can obtain relief under section 89(1) for timing difference. We'll get into relief under 89 at a later point in time where we might have to spend a lot more time to understand what it means. Provident Fund, there are different types of Provident Fund: recognized Provident Fund, unrecognized, statutory, or public Provident Fund. How does it work? For during the course of employment, employer's contribution to recognized provident fund up to 12% of salary is not taxed. Beyond that is taxable. Unrecognized, not taxable year on year, but it is fully taxable on withdrawal. Um, Statutory provident fund fully exempt. Public provident fund, employer will not contribute to PPF, but it will only be the employee's contribution. Next, employee's contribution. It is eligible for reduction under ATC. Not eligible. Stat contribution is eligible, and PBF also eligible. Interest in excess of 9.5%, but today the interest what they pay is anywhere between 8.5 to 8.8%. So for recognized provident fund, statutory provident fund, and public provident fund, as of now is fully exempt given the current regime of interest. Unrecognized provident fund not taxable on a year-on-year basis, but on maturity it is fully taxable. At the time of retirement, when it comes to statutory recognized or public provident fund, whatever you receive from the corpus is fully exempt. Unrecognized provident fund, amount received on maturity of unrecognized provident fund, it's not, employees contribution is not taxable. Interest is taxed as income from other source. Interest and employers contribution is taxed as salary. Very rarely you see employers having unrecognized provident fund. So from a practical standpoint, it may not make much relevance. We could dwell deeper into that. Accumulated exemption of accumulated balance in recognized provident fund up to 5 years of completed service. There's no 5 years and beyond. There is no tax on that. But however, if it is less than 5 years and the amount is being withdrawn because of terminal ill health or discontinuance of business, or for reasons beyond the SSE's control, there again it is not taxable. It is exempt. But where it is transferred from an existing employer to a new employer, not taxed. It is transferred to, it is exempt at that moment. It is transferred to a national pension scheme. Again, it is not subject to tax. But where none of this happens, then the amount is taxable. Please understand, amount in a recognized provident fund, if it is withdrawn after 5 years, it is not taxed. If it is withdrawn prior to it, consequent to ill health or for reasons beyond the control of the SSC, then again it is exempt. And then if it is not taxed, but it is transferred to a new provident, a recognized provident fund of a new employer, not taxed. Transferred to a national pension scheme, then again not taxed. If none of it happens, it gets fully taxed. Next, retrenchment compensation, where this is something which is happening currently. Employers are doing mass retrenchment of employees. Then, in such cases, any amount received under retrenchment compensation scheme, the least of the following. So, 5 lakhs actual amount received and the amount calculated as per Industrial Disputes Act, which is 15 days salary for the last 3 months, average salary of the last 3 months for the number of years of service. If it is received in accordance with the scheme which is approved by the central government, it is not taxable. It is fully eligible for exemption. So, as far as retrenchment compensation, maximum exemption is only 5 lakhs. Voluntary retirement tendency. This invariably happens either when they want to reduce the team or bring down this or replace it. But replacement again has some checks and balances within the tax exemption per se is concerned. So VRS least of the following: maximum amount is 5 lakhs, maximum limit exemption. Actual compensation, last drawn salary for the remaining months of service left, and 3 months of salary into last drawn salary into completed years of service. So no exemption is if relief is claimed under 89 subsection 1, which is a timing relief which is being offered to employees. So VRS retrenchment compensation, the mechanisms are fairly straightforward, friends. Moving on, relief under 89. What does relief? I'll give you a high level perspective. Relief under 89.1. Let us assume you have received arrears of salary. So, which is, let's say, pay commission arrears, seventh pay commission, eighth pay commission, where they give you arrears with retrospective effect. Effective for 2015 to 19, your salary has been, say, 5 lakhs, 5 lakh 50, 6 lakh 650. Every year, this has been your salary. And now your employer says, the government says, you will get an arrears, which will mean every year your income is going to go up by 1 lakh, and that 4 lakhs will be received in 1920. And let's say to 1920 your salary is 7 lakhs. If you add that 4 lakhs to 7 lakhs, you go to the next slab and you'll end up, and your salary of 11 lakhs will now be significantly, tax on the 11 lakhs will be significantly higher. But if you get into the details of this 4 lakhs is 1 lakh increase from 15, 16, 16, 17, 17, 18, 18, 19. So what the provisions under 89.1 say, whatever is a tax which you would have paid as if these amounts were receivable in those years, that should be the tax payable even when this amount of 4 lakhs is received. So what you will do, you will go back, you will add this 1 lakh for each of these 4 years, determine the excess tax payable. Let us assume that excess tax payable is 30,000. Now, whatever is the tax which you will pay if this amount is added to your current income, say 7 becomes 11. Let's assume that excess tax is 1 lakh. The difference between these two, 1 lakh and 30,000, will be your relief under 89. So 89 gives you a benefit where if arrears of salary is received, you are not expected to pay an unduly high amounts of tax consequent to the timing difference of receipt. Now let's get into the section with this example. If the assessee has received any portion of his salary or family pension in arrears, owing to which he gets taxed at a higher rate, on an application, the AO shall grant a relief under 89. Application, if he is entitled to a relief, the assessee shall furnish the particulars in Form 10E for the purpose of claiming this benefit. So we've seen what I've told is what is being given as an example. 67-year-old gentleman, taxable salary 710, 825, and 950. Arrears are given. Difference in tax, including arrears. This is exactly how the relief mechanism works. Some of the judicial precedents in this regard, friends, where a company has made a provision for managerial remuneration, it has created an obligation on assessee to bear the tax liability on the salary. So when you make a provision for salary, automatically you're liable to deduct TDS under 192. Where on assessee leaving the job of Google USA and joining the Indian subsidiary of Google India, Google USA realized stock held by the assessee under ESOP and remitted same through Google India. Gain on such sale could not be deemed as perquisite because it was for the period of service held there. But however, it would be deemed as capital gains. where an assessee made part payment of fees of children of its employees to an educational society to recoup deficiency suffered by said society, and the burden borne per child per month had never crossed 1,000. No perquisite would arise in the hands of the employee because the benefit of 1,000 rupees per month was always available. Where an assessee received salary from his previous employer after deducting notice period as per job agreement, it was actual salary received that was taxable and not the amount received as notice pay. Could not be taxed as salary income because notice what effectively happens. Let's say you're supposed to serve 3 months notice with your earlier employer, and your new employer says no, no, you'll have to join in 1 month. In which case, you will give him 1 month's notice and say deduct 2 months of my salary. And when you move to a different employer, the new employer will say, I'll absorb the cost of your joining bonus. So this joining bonus will be added to your income and notice pay will not be taxed. Uniform allowance paid by employee by assessee to its employees could not be regarded as additional salary in the form of allowance within the meaning of 17.1, where an assessee hotel collected tips from guests on behalf of its employees. Since contract of employment was not approximate cost for receipt of tips, it would be outside the ambit of 15 and 17, and he was not required to deduct TDS because tips was not consequent to this employer employee. The SSC only was a conduit for collecting this money. However, it is income for the employee but not from the employer, so it won't be taxed as salary income. So these were some of the thoughts when we thought we would like to cram the entire provisions of salary under one session of 40-50 minutes. Hope this made sense. See you again soon on another interesting topic of relevance. Thank you.